Hi, welcome to the SP7 class. SP7 is one of two papers in the SP series on core general insurance. While we have SP1 for health, health is usually not included in the general insurance track by the IFOA and IAI, and they are created as a separate track. SP9, which is enterprise risk management, also has a separate track and thus does not fall under general insurance. Usually SP7 and for that matter SP8 is also taken by students who are done with their CS, CM, CB and sometimes CP series papers as well. It is usually recommended that you finish at least the CS, CM and CB series before you move on to the SP series, because the CS, CM and CB series provide a base for your SP papers which will be useful. This brings us to the next question, which is how is the SP paper different from CP, CB, CS and CM papers? And the difference comes primarily in four big buckets that are there, which is specialization, complexity, subjectivity and marking. SP papers often have an emphasis on specialization that other C-level papers just do not have. C-level papers that you have done till now, which is your CP, CS, CM, CB, they offer either a generic subject matter or they offer an introduction to the subject, which SP papers are not. SP paper portions go deep into the topic that it is based on, and the exam questions will also reflect this. The institutes expect students to have a sturdy and in-depth understanding of the topic in questions, and the SP exams are more challenging than the other papers due to this particular specialized nature. As such, the questions and answers for a C-level course will not require a lot of depth. For example, many questions will require calculations from the students. SP level courses are not like this. In fact, there will not be a lot of calculation required in these papers. It is usually important to have a deep understanding of the subject and answer with depth rather than breadth. SP subjects focus on the ability of students to provide content that is relevant to the topic at hand and ensure that your depth of answers reflects your knowledge of the subject, and not just knowledge of the subject but a deeper level of knowledge of the subject. Subjectivity is a main problem with SP level papers. SP level papers generally tend to have a greater amount of subjectivity in the questions that are asked. This is unlike the CS, CM, whatever C level papers, where the questions are not subjective. The questions are straightforward. Whereas in SP level, you will not have SP, and for that matter, even SA level, you will not have straightforward questions. Your questions will be very, very subjective. A lot of questions will be in the gray. This results in a lot more thought required before you answer the questions. So you have to spend the same amount of time answering the questions, but you have to give it more thought, which makes it more difficult. Exam questions are also very difficult to answer and require careful planning because of these factors. Marking of the exams is also slightly different when compared to your C-level papers. Like I mentioned before, answers should have depth, but in some cases, you have to also identify cases where answers require breadth as well. We will discuss more of this when we handle exam questions, and we will discuss more of this from an exam technique lens, but the marking per se is also a lot more stringent than C-level markings. So when an examiner marks your paper, the level of content that is required for the examiner to give you, say, 70% of the mark or 80% of the mark is much higher than that of a C-level paper. Before we explore the details of SP7 and jump into the topic level weightage of SP7, let us just take a look at what SP7 is all about. SP7 is a paper that tests the students' understanding of techniques and concepts in three areas of general insurance. They are reserving, capital modeling, and insurance accounting. One thing to note here is that IFRS 17 does not fall under the purview of SP7. It is a SA3 topic. In reserving, we will primarily look at techniques that help us in determining the best estimate reserves for a general insurance company. We will first understand the different types of reserves of a general insurance company. We will go through what basis of reserving means and go through all the relevant bases used commonly. We will go through the current techniques used in reserving, where we will explore both analytical and stochastic techniques, and we will see how to obtain estimates of reserves using these various different techniques. We will also look at how reserves are communicated to the end users, whether it is management, whether it is the appointed actuary, whether it is any other person. And we will look at how reserves impact your insurer's accounts. In capital modeling, we will look at techniques that are used to estimate the capital requirements for a general insurance company with a given risk appetite and a risk tolerance. We will first lay the groundwork on different types of risks that are there. And this groundwork is extremely important for both SP7 and SA3. We will go on to see methods that are used to determine capital adequacy, and then look at steps, and then look at how diversification, things like diversification helps. In insurance accounting, we will look at building the revenue account, the profit and loss account, and the balance sheet of an insurer, and look at how reserves from step 1 impact a company's financial ratios. We will go through the basics of insurance accounting and all the rules that need to be followed. We will also go through some examples which we'll solve in real time. And one thing to note here is that insurance accounting questions in SP7 is oftentimes ignored by a lot of students because of how many of the reasons, primarily being perceived difficulty. However, what you will see and what we will explore is the fact that if you are well prepared, oftentimes this topic will give you the highest mark for the lowest amount of time spent. Throughout the course, we will also focus on solving hypothetical scenarios related to reserving, capital modeling, and accounts. Let's take a look at the pass rates for SP7. I've plotted a graph of the pass rates and pass marks for subject SP7 from April 2020 to the last diet, which was April 2023. April 2020 and September 2020 were anomalies primarily because of the kind of questions that were asked in that particular diet for the IFOA. And it has been mentioned by various tutors, various forums, various Reddit threads that April and September 2020 were clearly an anomaly, which will never be repeated again. And the experience that we have seen afterwards also proves that. What we have seen is that the paper is becoming slightly difficult over the last 2 to 3 diets, which can be seen by the reducing pass mark. And pass rates have been more or less stable at about 40%. The average pass mark for subject SP7 is around 61. The target for passing this paper that students should set should be 65. So if you set yourself a target of 65 for the exam, you might get some, you might lose some, and you might just pass with 61, right? So coming to the topic level weightage of SP7, one should note that SP7 and SP8 have a fairly high degree of overlap between each other. In fact, the first 10 chapters of SP7 and SP8 are almost identical with very, very few changes in the middle. But if you take a look at SP7's weightages, 20% of the paper goes towards general insurance products. Risk, uncertainty and regulations form about 15%. Reserving is the biggest chunk at 30%, and capital modeling is a slightly bigger chunk at 17.5%. So what are the skills that are assessed in an SP level exam? Now, SP level papers have a split. Every actuarial paper for that matter has a split between knowledge, application and higher order skills. What changes between one level to the next is the amount of importance given to a particular type of questions. And in SP level, and especially in SP7, that is 25% of the question paper will be towards knowledge based questions. So knowledge based questions are questions that test the knowledge in a particular area of the subject and mostly depend on the ability of the students to either directly recall material or describe content from the material. 50% of the paper, which is half the paper, are application based questions. These are questions that test the application of concept mentioned in the text directly onto scenarios that have been provided. A simple example would be, here are some numbers, calculate the reserves, or tell me what are the impact that reserves may have on some hypothetical scenario. Higher order skills, which form 25% of the paper, are questions that test the higher order skills of students. That is, students' ability to apply, synthesize, and evaluate actuarial knowledge in real world scenarios. Higher order skills often go beyond basic knowledge and require students to have a greater depth of understanding of the concept, and students should often demonstrate a much more nuanced approach to the question. Higher order skills are generally the hardest questions in the paper, but they provide the best avenue for students to get marks if they have good exam technique and good preparation. Before we move forward to the structure of the content, let me give you an overview of how the course is going to be structured. We'll be providing you with the topic that is going to be covered in a particular day, and I would highly recommend that you do a complete pre-read of the topic before the class begins. I recommend this because this will give you some familiarity as we go through the topics, and your participation will be more engaging, and it'll actually help you in retaining more of the content. The course is going to be extremely collaborative, as I will have students solve questions either individually or as a group. In many cases, I will also create group discussions which will help in facilitating a better answer to the question, right? Videos will have to be on for everybody. This is a mandatory requirement. I want to see everybody when I take my class. I will also have small quizzes during the class to evaluate the understanding of the subject matter of the students. Finally, we'll also focus on exam technique to get better at writing exam responses during the collaborative sessions. Continuing with the structure of the content is broadly classified into the following buckets, which is general insurance and business environment, reinsurance, reserving, accounting methods and interpreting accounts, capital modeling and ALM, and reinsurance reserving. I will be prioritizing some topics which I feel are more important uh, before, and the ones which are prioritized less important will be taken towards the end of the course. I've reproduced the table of contents of the SP7 paper in this slide for your ready reference. SP7 has 27 chapters split into 6 different parts. As discussed, we will be clubbing certain chapters together in the classes to make the course more fluid. However, I will not be clubbing chapters from different parts. So you won't see me club, say, chapter 10 and chapter 11, which are in 2 different parts, to make it easier for you to go back and do your X series assignments and your tutorials. So a little bit about myself before we start. I have around 12 years of experience in the general insurance and data analytics space. I currently work as Chief Strategy Officer for AssureKit, which is an insurtech based out of Bombay. I have an AIA with the IFOA, and I'm one paper away from getting my FIA. I was a topper for SP7 in the September 2021 IAI Diet, and I've been an Arsenal supporter since 2002. So if anybody want to discuss Arsenal's performance in the EPL or the Champions League, please feel free to reach out to me after class. Subject SP7 by looking at an overview of an insurance company, the insurer's balance sheet, and an overview of insurance itself. If any of you have worked in an insurance company, this should be very familiar, and it should mostly just be a refresher for something that you already know. Before we jump into an insurer's balance sheet, at a higher level, we need to first get clear on the why for insurance. Why does insurance exist? I think each of you will have a different answer if you try attempting to answer this question, and there are probably no wrong answers. But fundamentally, according to the CMP, insurers exist for 2 primary reasons. The first one is to make money. Insurers are not a charity, and they are therefore making a profit. It is a for-profit enterprise. The only exception to this rule is probably mutual insurers.
And a perfect example of a mutual insurer would be Lemonade or Liberty Mutual, where a customer who purchases a policy is made into a shareholder, and the insurance profits that are derived at the end of the year are paid back to the customer as a dividend. The second reason is to meet a need. At the end of the day, supply for insurance exists because there is a demand from customers for the product. If there were no demand for insurance, insurers would not exist. Over the next few slides, we're going to focus on the following topics, right? The first one would be to determine the components of an insurer's balance sheet, along with an introduction to each component. The second would be to determine what capital modeling is and how it links to an insurer's balance sheet. The questions that you get asked in SP7 and in SA3 are going to be higher level order questions on this linkage. With an insurer's balance sheet. An insurer's balance sheet is very similar to that of any other company's balance sheet, i.e., it has assets and it has liabilities. However, the type of assets and the type of liabilities it has is completely different when compared to any other company in any other industry. The biggest component of assets for an insurer would be its investments. Remember when I told you that insurance is a for-profit enterprise? This is one of those biggest drivers of profit. Would you believe if I told you that a majority of general insurance players in India are not making underwriting profits and only make money through investment profits? We will go through what underwriting profits and investment profits mean shortly. Investments and profits from investments are a very large and major driver of profits for insurance companies. Investments are basically securities that are invested by the insurer. These securities are often interest generating and are diversified across multiple asset classes ranging from equity, realty, bonds, and stocks. The investments also have different tenures. For example, insurers could invest a portion of their bond portfolio into short-term bonds and another portion of their bond portfolio into long-term bonds. What is important here to link is that the asset profile of the company and the liability profile of the company have to be matched. And this is where the linking between assets and liabilities, which we will study in ALM, comes into play. The investments a company can make is also usually heavily regulated by the local regulator, since the consequences of an insurer misusing them is completely catastrophic to the not only to the company, in some cases it might also be catastrophic to the nation as well. A perfect example would be a mismanagement that was the perfect example would be a mismanagement by AIG during the 2008 crash. They had over leveraged on CDS and they ended up requiring a bailout from the government. Fixed assets are any immovable assets that are owned by the insurer. You have to differentiate between fixed assets and investments. Investments is monies that are in revenue generating, interest generating from the insurer, while fixed assets are assets that the insurer owns. A perfect example of fixed assets would be property and equipment, computers that the insurer owns. This is not a very important area for subject SP7. Most of the points relating to fixed assets generally come as part of expense management and things like that. So you can get about 0.5 to 1 marks here and there by mentioning fixed asset as a separate point. Although SP7 as a subject, and for that matter general insurance as a subject, does not go very in depth into fixed assets as a whole. Net current assets of an insurer represents the current assets of the insurer, and these are generally defined as the excess of assets over liabilities. Assets generally that materialize before 12 months is classified as net current assets. A perfect example would be broker's balances. A broker's balances, for those who don't know, is money that has been parked by the broker with the insurer as part of an asset. The technical reserves are the most important aspect of subject SP7. A majority of the subject is derived from technical reserves. Technical reserves are the amounts that are set aside by the insurer, which represent the expected claim payments to customers. Claims handling expenses could also be part of these technical reserves, although there are some who don't add it, there are some who add it. But more often than not, in final definitions, claims handling expenses are also part of technical reserves. They are also called as insurance reserves, and they are split primarily into two parts. The first are any liabilities for outstanding claims. And what are outstanding claims? Claims which have been reported and a reserve that has already been created by the insurer for. And the second is liabilities for future cover from policies that have already been written, and these are known as unexpired risks. SP7 is effectively a paper where A, you have to determine what that component is. B, you have to identify all the risks associated with determining that component and how that impact flows upstream. And C, how is this figure accounted for in the balance sheet? We will also explore how to estimate outstanding claims reserves, and this is usually done using two primary methods. The first method is a case-by-case basis, where you make estimates of liabilities for each individual case. And the second is using statistical techniques to estimate the total outstanding reserves for the entire portfolio. Now, there is a determination that needs to be made. There are actuarial judgments that need to be made on when you can use case by case and when you should use statistical. And a very interesting question for you to ponder is, can you determine IBNR from a case by case basis? And one thing that you have to also understand when you are trying to solve these kind of questions, when you're trying to answer these questions, is not only answer yes or no, but also answer why. So if the answer is no, why is a question that you need to think about, right? And this kind of also impacts how you answer questions in the exams. We will also see each component of technical reserves thoroughly in the next few classes, and hence I will not be going into detail for each of these components. However, a big focus of this paper is going to be, and the big focus of this class obviously is also going to be on the breakdown of this technical reserves. Component of an insurer's balance sheet is the free reserves. This is usually the balancing item between assets and liabilities and is also known very importantly as shareholder funds. Free reserves and shareholder funds are usually used interchangeably, and you have to be very, very careful and you have to be very, very vigilant. If somebody says free reserves or if somebody says shareholder funds, they mean the same thing. An insurance company cannot exist without free reserves, and even though this is known as the balancing item, this is perhaps one of the most important aspects of the balance sheet of an insurer. It's very important for solvency, and usually there is a legal requirement on how much free reserves an insurer should maintain. If you look at Solvency II guidelines in the UK and in Europe, it is often there are two components that you will probably have heard. One is MCR and one is SCR. MCR is the minimum capital requirement and SCR is the solvency capital requirement. These are very important when you go to subject SA3. The free reserves also contain retained profits, and it also represents the part of the capital that can be used for growth projects for an insurer. So you might ask, why are free reserves important? Free reserves are important primarily because A, they determine the maximum amount of business an insurer can write. So as I had mentioned before, insurers have MCR and SCR guidelines to follow. This means that the amount of business that they can write and the amount of profits that they can enjoy is limited by the amount of free reserves they have. Companies with higher free reserves can choose to write a greater volume and enjoy a greater profits. This is also very important from a question answer perspective for exam SP7, not only exam SP7 but also exam SP8 and SA3. most of the questions have keywords in them. And if you see a question with a keyword with small insurer or medium insurer or large insurer, you have to understand these impacts when you answer those questions. Now, the second point is with respect to volatility, right? How much volatile business can a company write is also dependent on the amount of free reserves that are there. Companies that write longer term and more volatile business need to have a higher amount of free reserves. Alternatively, you can also say that free reserves will play a very important factor in determining what a company writes. Free reserves also helps determine the RI strategy of the company. The free reserves will indicate how much a company is reliant on RI. This is usually a very important point in exams. Like I had mentioned, exams usually have keywords. For example, a small GI company that specializes in liability, or a large general insurance company that specializes in multiple lines is usually how a question starts. So a small GI company, for example, you have to understand that a small GI company means that the company has limited free reserves and hence might be reliant on reinsurance to support its expansion. The fourth point is determining growth strategy. So companies with larger amounts of free reserves can grow their business by implementing new things because they can absorb losses that are made from new ventures at a greater level than companies with very low free reserves. So free reserves is basically the heart of a company, and it determines how much a company can experiment, how much a company can write, and how much a company can enjoy freedom in the market. Before we move on to capital modeling, let's take a look at some of the other aspects of an insurance company that we will be covering over the course. I'm not going to go into a great amount of detail with these aspects because we're going to cover them in depth. However, just let's get an overview. The first one aspect is reinsurance. Now, for those who don't know what reinsurance means, reinsurance is nothing but insurance for insurers. Just as how a customer takes an insurance policy from an insurance company to protect their assets, an insurance company can take an reinsurance policy from a reinsurer to protect their downside from the customer they have insured. The whole idea is risk transfer. Risk is transferred from the customer to the insurer, which is then transferred to the reinsurer, which is then transferred to a guy called retrocessionaire, which is then transferred directly into the capital markets. We will then look at underwriting results. So underwriting results are nothing but earned premiums minus incurred claims minus expenses. This is effectively the insurance profits that you're getting from your core business. Have you collected 100 rupees in premium? Yes. Have you earned 50 rupees in premium? Yes. Now, what was the claim payout in the year? Say 25 rupees. And what was your expense? Say 10 rupees, which means 50 minus 25, which is 25, minus 10, 15. So your underwriting profit is a simple calculation. Over the course of the classes, we will look at how to compute this underwriting results. We'll then go over claims characteristics during the course. And once again, we'll go into a lot of details. So I'm not going to go into any detail right now, but we effectively look at how claims characteristics impact every aspect of an insurance company. And finally, we'll go into a very important topic called tax. Now, tax as a topic has almost no relevance, or there are no chapters specific to tax in any general insurance subject, be it SP7, SP8. There's a very small topic for tax in SA3, which is completely outdated. However, this is a very forgotten thing by students during exams and is often the differentiator between pass and fail. So a relevant tax point in an exam will fetch you 0.5 marks. 1 mark if it is extremely relevant, but let's assume it's 0.5 marks. Across questions in an exam, tax as a single point can fetch you 2 to 3 marks. And if you are anywhere close to the pass mark. This 2 to 3 marks is the differentiator between a pass and a fail. And most students often fail to give tax as an answer. So this is something that we will focus on during our group discussions. The last point is profits. Underwriting profit plus investment profit is the total profit for an insurance company. We will see how this affects the income statement, how this affects financial ratios, and how these calculations are made in the balance sheet and how it flows from the income statement to the balance sheet. Before we finish this class, let's take a look at what capital modeling means. Like I had mentioned before, insurers will have to hold enough capital to meet all their obligations. Now, a very important qualification of that statement is that it's not enough if you have enough capital. You have to have enough capital to meet all your obligations with a certain degree of confidence. You might ask me what this degree of confidence means, and I'll give you a simple example. The regulator might ask the insurer to hold enough capital to meet all its liabilities 99.5% of the time. You might ask, what is this 99.5% of the time right now? So think of a simulation where there are a million scenarios which might happen, right? Right from scenarios where there are no claims to scenarios where potentially, say, every customer claims. Now, the insurer will say that you need to have enough liabilities to ensure that in 99.5% of these cases, you are going to remain solvent at the end of this claims process. So the process by which this confidence is determined is called capital modeling. So the next follow-on question from what is capital modeling is why do we do it? And a simple question which has a simple answer, which is regulatory requirements. Solvency requirements have been put in place by regulators to ensure that insurers do not go insolvent or bust. You must have heard of bust in terms of the probability of ruin and things like that back in your CM, CB, and CS courses. And this is the natural extension of those concepts onto real life insurance scenarios. The reason for doing this is because there have been historical examples of insurers becoming insolvent due to poor capital modeling activities. So the capital modeling frameworks that will be discussed in subject SP7 ensures that these situations are not replicated. We've seen the what, we've seen the why, and now we will also look at the how. So the question is, how is it done? So capital modeling is done by taking into account various risks that an insurance company faces and modeling the risks into a quantitative model. Capital models have a predefined structure with inputs, outputs, risk tolerance levels, and risk measures that they can take. And there are various requirements for risk measures, for example, coherence and things like that, which have to be met for that risk measure to be used. Capital models are usually stochastic and they're very complex in nature, although there are some simplistic and deterministic models as well. But of late, what's happening is that a lot of the capital modeling requirements have been moved from Excel to, say, a coding language such as Python and R, which is primarily used by actuaries. Before we finish, since we have discussed how to build a capital model which takes into account the risks, let us also look at what the risks that an insurance company face are. And these are primarily split into 8 broad categories, although there are a lot of new different types of risks that are available. And if you are very interested in learning more about risks and management of risk, subject SP9 will give you a good primer on this entire subject, right? SP9 is just how do you quantify each risk. In subject SP7, we touch upon these risks and we look at it only from a capital modeling lens and not from any other lens. Right? So we will look at these risks individually as the classes progress, and hence I'm not going into a great amount of detail, but I'm just going to give you an overview of each different risk that is there. The first one is underwriting risk. Underwriting risk is nothing but the risk of an insurer making a loss while writing business in the future. This is very important. This is future business. Next is reserving risk. And reserving risk is the risk that the technical reserves that we have just discussed is not adequate to meet liabilities. Credit risk is nothing but the risk of failure of third parties to pay money owed by the insurer to the insurer. So think of, say, a reinsurer who has to pay the insurer claims. Now, if the reinsurer fails and if the reinsurer does not pay the insurer back, that is a definition of credit risk. Market risk is nothing but the risk of changes to investments in the market leading to losses. So think of an insurer holding equities and the market crashing and the insurer facing losses because of that. Operational risk is the risk of losses to insurers due to the nature or way of their operations. So imagine a general insurer doing business and then they identify that there is a lot of fraud that's happening because of poor operations. This would fall under operational risk. Group risk is the risk that the company experiences poor results as part of a standalone group and not as part of an individual entity. So you have an insurer which is part of a larger group, and the larger group is suffering some fundamental systemic issue, and this impacts the smaller insurance company through no fault of their own. That is group risk. And then liquidity risk is the risk that the insurer does not have liquidity to meet its liabilities, immediate obligations. So a perfect example would be, say, a catastrophe happening and say a flood happening, and bunch of claimants coming into the insurer and making claim requests, and the insurer at that point not having money because they might have probably stored away a lot of their investments in long-term bonds, not leading to inability of the insurer to convert their bonds to money, right, which leads to a liquidity crash for them, liquidity position for them, liquidity problem for them, and this leads to insolvency. So that is the definition of liquidity risk. So all these risks, there are much more risks than this. So for example, there is strategic risk, there is administration risk, there is uh, IT risk, there is key man risk. So there are a lot of different types of risks that we will discuss over the course, but these are the biggest areas to discuss, and this is a good opening to understand what these risks are.